Let's connect with Arvind Sanger, Managing Partner with Geosphere Capital Management. Arvind, good morning, or rather good evening to you. Thank you for joining us. I know these are wee hours, so really appreciate and thank you for staying up for us. Arvind, of late, price action in Indian markets has been slightly inconsistent. It's no longer clear blue skies. There is Iraq. Macro data points are not that encouraging, and profit booking has kicked in.
Yeah, well, I think, the hope trade has pretty much, I think, run its course. We might get a little bit more of that, but at this point, we need the reality. And the reality is going to require specific policy actions by the government. So far, everything is hope of policy actions on the come. And now the moment of reckoning is upon us. And so what the market is now focused on is finding out what is the stuff this government is prepared to do. I think over the next few days and weeks and months, we will get a better sense of that. And the market is going to look for signposts along the way. And I know a lot of the focus right now of a lot of people seems to be on the budget. I think the budget is one important consideration, but there's other important things that I think are significant that'll determine, not all of which are going to come just magically out of the budget, which are all going to be important in determining whether or not, not just whether or not, but how much higher and in what direction this market goes or specific subsectors go. And you mentioned Iraq. I think Iraq is a huge wake-up call for India. I think, the Iraqi situation is obviously one of the countries most vulnerable to an oil price run-up. Historically has been and continues to be as India with both on the current account front and on the inflation front, to the extent that the government is looking to do away with subsidies, which I suspect they have to, then higher oil prices do create some risk. And I think what we have to be thinking about is long-term structural risk of not just what's going on in Iraq, but what's going on in the entire Middle East and what the implications of that for uncertainty around higher oil prices is.
So, Arvind, what's the view then on India? Because we too, while we are skirting around historic highs, we've gotten a little wobbly because of the domestic and, global pressures right now. What's the sense that you're getting? What is the market expecting from the budget? Because, that indeed is the next calling card and the next big trigger that is going to take the, market in either direction.
Sure. Well, I think, one of the things I'm certainly looking for, investors may or may not be pleasantly or unpleasantly surprised, is a more honest accounting of the budget. Stopping paying dues and showing that as budget discipline is not going to be a viable option for this government for a full 5-year term. So I think there'll be more honest accounting of pay-as-you-go accounting in terms of what the true deficit is, and then coming up with some structural solutions to fix the deficit, which I suspect have to include meaningful subsidy reforms. So if, Prime Minister Modi was making some comments, over the weekend about having to take some unpopular steps, I would assume, and frankly, the market would hope, that they would be related to, significantly hacking away at the, unproductive subsidies and being able to, make the budget more sustainable on that basis. So I think, that's one very important point. And the other important point is going to be, I guess, we talk about the budget, but railway budget again, subsidy for, not increasing fares by any meaningful amount in the last 10 years, doing more on that front. But then the other important side is kind of an investment led, where is the government going to focus its effort in terms of what investment is it going to encourage? What kind of tax policy, simplification of GST, whether DTC is going to be attempted, although I suspect that's going to be more a statement of principle, but some clear roadmap on timeline of GST and other things like that, which would give encouragement. But again, some of the things that need to come out are not part of the budget. I think it is high time India woke up and smelled the coffee in terms of what's going on in the Middle East and came up with a sensible policy on the energy sector, particularly gas prices, instead of listening to economic know-nothings like the Aam Aadmi Party and some of the sort of leftists put in place a globally competitive natural gas price so that you would encourage, gas investment or a clarity on oil and gas policy in general, which I think is critical for, again, tackling one of the structural longer-term challenges, which is obviously a big driver of the current account deficit. So I think, there are many things that the government can do, what it does in the power sector, what it does in roads and other infrastructure projects, not all of which I suspect will be all rolled into the budget, but all of which I suspect we will look, or at least many of these we will look for some specific policy announcements in the next 30 days. So I think, the month of July is pretty critical for the government to deliver on some of the, policy expectations. And if they do, frankly, I'm still hugely bullish about the Indian market. I think at this point, we just need to see specific actions, but my view still remains that the direction of this market is higher as long as the government follows through on what it has been, kind of.
Right. So, Arvind, let's talk about groups. What we've seen in last 2 months is that an undervalued market has got corrected. Mean revision has happened. Most of the economy-related groups, be it oil and gas, energy, or banks, they are up 50 to 60%. Do you think bulk of the mean revision in Indian stocks is over, and now price action will be a function of earnings?
I think now price action would be a function of not so much earnings, because earnings would mean meaningful earnings turn may still be a couple of quarters away, although earnings have started to improve, but some of that short-term earnings improvement is already in the share prices. So I think from this point onward, it's going to be things that give us confidence that maybe in the second half of this fiscal year or in fiscal 16, there will be meaningful uptick in earnings. So any policy actions that give us hope on betting on an FY16 much higher earnings number than what consensus is currently forecasting, and whether that is in companies that are in power or in infrastructure or in real estate or in cement or in energy. I mean, there are many such domestic-facing sectors, or even, commercial vehicles or auto sector or what have you. If there are going to be, things that will provide confidence that in the next 6 to 9 to 12 months, meaningful upturn will start to happen in earnings, and even if near-term earnings are not going to pop on any policy actions taken in the near term, I think the market will build in higher multiples short-term, counting on companies' earnings growth to justify the higher prices. So I think there is still room for upside in many of these sectors, but it'll have to depend on some specific roadmap that we can then see to meaningful earnings recovery.
Okay, so Arvind, if one works with the assumption that Q1 earnings for some of these economy-related sectors and economy-related groups will not be strong, so in the short term, in the medium term, is one better off still buying into IT and pharma, because that's where the growth is and that's where the earnings surprise would kick in? Because for the moment, power companies or engineering companies or industrials are unlikely to surprise us.
Well, I think that's an interesting question, because so far, our call has been to avoid the IT and pharma names just because the market was going to rotate away. But obviously, in the last few days, as there's been some rotation back into some of those sectors, and clearly the rupee weakness has certainly helped a little bit. And I think that's where the oil price action has taken some of the bloom off some of the other sectors and off the currency. So I would say that I think it's still going to be, I don't think IT and pharma suddenly become no growth sectors. Their growth is still meaningful. They still have reasonable valuations. So yeah, I mean, I think they provide, in my opinion, a relative safe haven in terms of during periods of turbulence and uncertainty. In terms of which sectors. One of the things that we have to keep in mind when people are betting on a lot of these domestic-facing sectors, that the government is not going to be able to satisfy every constituency of every sector in one fell swoop in the first year. So there are going to be some disappointments. So I think on a risk-reward basis, some of these sectors may end up, well, I don't know which ones necessarily, but I have some views. I think some of these sectors may end up being unappealing, and therefore you could see some investors, in terms of taking a safety attitude, rotate into IT and our pharma. And also you could see if there's some disappointment on the monsoon and inflation, becomes a bigger concern, then the banks could see a bit of a sell-off. So I think there are some negatives on the horizon, both on the monsoon front and on the oil front, which has caused attractiveness. I would say the quarter by itself, if that were the only issue, that the earnings of this quarter, then I would say that alone wouldn't make IT and pharma standout performers. But coupled with the backdrop of the oil prices creeping up and the currency weakening and the fears of a monsoon, that makes on a relative basis some of the laggards in those sectors somewhat safer havens.
Right. So, Arvind, finally, give me a flavor of your current India commitment. I distinctly remember last time when we interacted with you, you had exposure to metal names, you had exposure to energy names, you were bullish on Reliance, and you also had a decent exposure to Kane.
Well, I think that maybe while I won't discuss specific names right now, but I would say that in terms of sectors, one of the sectors that we are particularly intrigued by right now is the cement sector. And the reason we like the cement sector is we think that no matter where the infrastructure spending goes, I don't care whether it is ports or it is rail infrastructure or it is building new housing, low income or otherwise, or building more urban infrastructure. It almost doesn't matter. Cement is a sector which has seen for 3 or 4 years sub-GDP growth. I think we're about to enter an era where if the government is, even moderately successful, where cement demand growth could be 1.2 to 1.5 times GDP growth, and GDP growth itself should recover. And there isn't, after the current fiscal year, much new capacity coming on. So I think this is a cyclical sector that is setting itself up for a very good run over the next few years. And then we like select stocks in energy and in some of the infrastructure space and some of the rail infrastructure. So, there are specific stocks that we like. But I would say that, in the very near term, we've taken a little bit of chips off the table because of having, and one of the concerns we have is in some of the PSUs that have run up, whether it's in the coal sector or even in the power equipment sector. I'm not sure that the solutions are that simple that you could not have some disappointment. So, we're keeping an eye on some of those where we think the structural problems are not that easily fixed.
Right. Arvind, what is it that you made of what we heard from Mukesh Ambani yesterday at Reliance's 40th AGM, and a rather somber mood over there, not really outlining or giving out details, but yes, a massive capex for the next 2 years?
Well, I think Reliance's annual meetings are always a big picture, long-term view, and I think there wasn't anything that I heard that was particularly surprising there. Major projects in petrochemical and refining have been going on now for over 12 months, and those are pretty visible large projects which are really brownfield projects which will significantly enhance earnings and cash flow starting in fiscal 2016, but really fiscal 2017 when it get meaningful effect. So that's clearly going to be a big earnings driver, which I think is visible longer term. And then I guess if there's one area where we and others, I suspect, are not as clear where things are going, it is the Reliance Jio and the whole telecom, and I guess they're giving us a little more color, or Mr. Ambani gave a little more color on that. They obviously have a strong strategic vision. I, for one, along with others, remain somewhat lower conviction in terms of wanting to pay much for that right now till we see how that works out. And then the retail side, I think, with the pullback of expenditure by the Future Group, the field has been wide open for Reliance in retail, and clearly they have seized the lead, and it's easier to see the value being created and the ability to unlock that value. So I would say that overall we see the value unlocking. We just don't know how to handicap the amount of value being created in the telecom business. But overall, it's an ambitious target. I think Reliance, at least in the petrochemical and now and refining and now increasingly in the retail space, has shown that it can execute.
Arvind, for the longest time, Reliance has always traded at a PE multiple which is slightly at a premium to other global commodity stocks. Now that the company has indicated that they would have a strong telecom presence, they would have a strong consumer face, do you think it's a matter of time markets could re-rate the PE multiple for Reliance and soon it could go through a cycle of PE expansion?
Well, I think that's possible. I think it becomes a question of, where are the ease in the other businesses versus the value being created. And so to the extent that the earnings delivery in the non-energy businesses, and even in the energy business, the investment is coming first and the earnings will come later. So in some sense, if the earnings visibility becomes more certain, then the market will jump the PE in anticipation of the earnings showing up in a year or two from now. So yes, but that's more, I don't know if I'd call it re-rating, but more confidence in the earnings delivery coming a couple of years out or a year or two out. And as that becomes more, the market becomes more confident, then the near-term earnings multiple will start to look quite high.